We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you if you raise your hand. We'll do one question and a quick follow-up and ensure that everyone gets a chance, and then depending on the time, we may have time for a second round. The Governor will be happy to answer questions in both official languages. Avant de poser une question, priez de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser des questions dans la langue officielle de votre choix. Thank you. First question is Fergal.
Fergal Smith, Reuters. Morning. So what does Governing Council need to see before January to support another rate hike?
Well, I'm not going to put out the conditioning statement that if we see this, that, and the other thing, we would see a rate hike. That would be to short circuit our own process. But what we need to understand before we can even sit down and talk about what's next is we need to understand the extent of the macroeconomic effect of what we're observing in oil markets. During that time period, we will not only be working with our models, but having our next round of boss interviews. And so we'll have updated information from that source, as well as some special targeted visits to players in the energy sector. So just like we did in the early weeks, the last weeks of 2014, the early weeks of 2015, we'll have a lot more information by the time we get to January to understand that, which is just the most important new shock that we're dealing with. The other one we need to understand better is the effect of the historical revisions that I mentioned in the speech. It means that the level of GDP is lower than previously thought by close to 1%. And what we need to do is work through the underlying details of that to figure out how much of that would be now part of the structure of the economy, therefore supply, and how much of it would be attributed to demand, which is a difficult analysis that we do. We do it roughly twice a year as things accumulate. And so that's a lot of analysis that I can't prejudge, so it's not like I can give you three things that must happen at all. I would note that I mentioned this morning that in the last 6 or 8 weeks, it seems like most of our data points have been a little on the disappointing side, but this morning's data from the trade side were a positive surprise relative to what we were forecasting. So, this is the way the ebb and flow of the data work.
Do you have a follow-up?
I do, yes. Governor, is it fair to say, though, that the timeline to get back to neutral has now been extended?
Well, we didn't change interest rates yesterday, so it depends on what your expectation of that timeline was. And I'm not going to give a timeline. The whole discussion that we went through in October about changing the word gradual to a more fulsome description of how the pace of interest rates would be considered was purposefully to get people looking at the data, not presuming a certain pace of interest rate change. So the market was bound and determined that we were going to raise rates every second meeting. That was, too much regularity for my taste, not data dependent enough. And so we've made it clear, I think, what are the various things that go into determining that piece. And we made it clear that the idea was to allow for it to be either slower or faster than what market expectations were. Agnostic on that, data dependent. That's it.
That question is Kim over on the right.
Hi, Kim.
Hi, Kim McCrail from the Wall Street Journal. I wanted to ask about some comments you made during the question and answer session about the neutral rate. You said it's hard to tell exactly where neutral is until you're there. Are you constantly evaluating the estimate of neutral? Is that something that you review at each decision? And what might cause you to change that estimate?
So the research that backs up that range that we cite has been dusted off pretty well on an annual basis. And last time we did it, it didn't change. So that's fine. But the notion of knowing when you're there, it's like I've described before, that as you're in real time, as you're accumulating the evidence that, you know, the interest rate adjustments that have taken place are having this size of an effect on people and having this much of an effect on other spending outside of housing, you begin to form up a picture which then allows you to calibrate what is going on relative to your understanding of the potential of the economy. So that is a very complex number of ingredients. And so just take, for instance, you know, if we get the investment rebound that we expect, then that would feed into our estimates of the capital stock and therefore Canada's potential growth rate. And so if that were to rise by 1/10 or 2/10 above our current baseline, that would be unambiguously good news for the economy, and it would be creating room for growth in a non-inflationary manner. So it's all about how all those things come together into your inflation forecast. And so in that sense, it is, as you described, a completely continuous process. And the notion of what's the appropriate interest rate at a point in time or for a period in front of that is completely dependent on all of those things. So it's impossible just to distill it down to, oh, if this, then that. It's simply not like that.
Thank you. And I'd just like to follow up on Fergal's question about your response to that, about visiting with individuals in the companies in the oil patch. What are you looking to hear from them? What might inform your decisions going forward from what you hear there?
So like last time, we'd be most interested in their plans for investment, you know, in spending in general. So when we're looking at the macroeconomic effects of lower oil receipts by companies, which is what we're looking at here, we can do the fine arithmetic around you know, how much production do we have of light oil? Which, see, this is the new thing in the analysis, because back in October we knew WCS was under stress. It was selling at a very cheap level. But we believe that the refinery shutdowns in the U.S. were playing an important role in this, and that therefore, well before winter, they'd be coming back on stream, and so the gap would narrow. And that's exactly what has happened. But at the same time, the growing stockpiles of light oil has meant there's a big increase in the discount applied to, you know, the bulk of Canadian oil, not just the WCS, which is just the heavy part. Exports of WCS are, you know, a small fraction of the total our exports. Important fraction, but a smaller fraction, I think, than most people think. So it's the effect on light, which is the newsworthy item here. And so doing the arithmetic through all those types of oil and how much receipts have been knocked down, that changes our estimate of income for the country. And then up against that, we would have a second layer of response, which is, what do companies do now that they have less income? Do they cut back their plans for expansion? Probably. Do they cut back, you know, more ongoing investment? Do they cut staff, etc.? So those are the kinds of insights we'll be looking for from those interviews, so that we can add things up to kind of get a sense of the macro scale of what we're looking at. As I mentioned, the oil and gas sector contributes, you know, so around 3.5% of Canada's GDP to get today. So it's, you know, it's quite large. It's for example, for scale, the auto sector is like 1% or that sort of thing. So it's a very significant sector. And so what we need to do is calibrate how much of an adjustment is needed. And of course, the whole thing could be temporary if we get a major development on the OPEC front or some other global change. So we'll have to take all those things and do a fuller analysis for January.
Okay, I've got Peter Diekmeyer on my list, Peter Armstrong, Esteban, and then Greg. That's what the list goes now.
Hi, Peter Armstrong, CBC. As you evaluate that impact on the oil industry, how large does 2014 and 15 loom when the economy refused to behave in the way that we kind of expected it would in terms of the transition to manufacturing and dollar and all of that? Does that loom quite large in your analysis now that it didn't do what you sort of thought it would then?
Well, actually, I'm very, very pleasantly surprised by how well the economy tracked what our models said would happen in the wake of the 2014-15 oil shock. It's a shock that most models are not built to handle, and it's why our model is called totem. It's because the TOT stands for terms of trade, and most macro models, in fact, to my knowledge, in Canada, it's really the only one that has that properly modeled. And so all the work we did paid for itself in just that one shock. And what it said was it would take 3 to 5 years for the economy to complete its adjustment to those lower oil prices. And by that adjustment, what we mean is that the share of the GDP in that sector would decline while other sectors grew faster. And that whole process would be speeded up by a lower Canadian dollar, which is the other part that we always see when oil prices go down. And all those things happened, and actually the adjustment, I think, was speeded up by the fact that we cut rates twice in 2015. So that meant all the adjustments got sped up. And so after 3 years, we were feeling quite comfortable. In fact, there were still adjustments happening in Newfoundland or Alberta, Saskatchewan, but those would be the other half. When I say 3 to 5, because there's a lot of things that still happen. But the extra growth that we'd expected to see elsewhere in the economy has actually occurred. Exports of non-energy goods have picked up, and services especially so. And so we had a reversal of we had the strong energy and soft rest, and then they traded places at that point. And so I'm very pleased with the way the staff worked that all out. And like I said, for the past year, the economy has been operating at potential, and inflation's been on target. So if we had not got it right in 2015, we would not be at potential and at target. Okay, so it takes 2 to 3 years for all those things to sort out too. So there's the proof that the thing did a good job. It gave us good guidance. Now, what about today? Well, as I said in my speech, on first pass, we start from a smaller sector, a consolidated sector where they've cut costs and everything more efficient. So we have to recalibrate where we start, and so it's not just another shock. It's different. So we have to do a lot of work with that to fully appreciate it, and we'll be supplementing it, as I said, with anecdotal evidence from actually talking to the people making the decisions. It feels like it pretty well has to be smaller, that's from what we know today, than it was then, but that doesn't make it less important, certainly to the people who are affected. So we're taking it seriously. It looks like it's material at this stage, but smaller.
Peter Diekmeyer.
Governor Poloz, last year when you spoke here in Toronto, in paragraph 19 or something like that of the speech.
Okay.
Some of us follow you really closely.
Better than I do. Tell me what I said.
You made some comments about Bitcoin.
Okay.
Which proved to be quite prescient because the currency or security subsequently plunged by something of the order of 75% after you spoke.
Yes.
Which turns out to be probably the most prescient call that we've seen from any major financial expert here in Canada. So my question relates to whether this collapse in Bitcoin is a sign of overall fragility in the markets, and if so, is there any Bank of Canada backstop? Like, is there a Poloz put somewhere where you guys are going to jump in and help out?
Help out the Bitcoin market?
No, the overall markets. If Bitcoin, what we're wondering is that,
okay,
you know,
got
when
it.
markets collapse, usually it starts with the more fragile
got
areas.
you.
We're talking Bitcoin, FANG,
Yeah.
and then it rolls down into more heavier assets. Is there a Bank of Canada back, like we know you've been,
Okay. So point A, I would see no connection between them whatsoever. I said last year that you know, the Bank of Canada has very little to do with cryptocurrencies. I don't even like the term, frankly. They're crypto assets of some form. That in fact it's like it's not an investment. There's no intrinsic value. Therefore, you're just playing in a casino. That was roughly what I said a year ago. And anyway, whether I was a prescient call or not, I leave to you. But the point is that it's fairly obvious to me that there's a lot of very interesting and useful technology emerging in that space. But I'm not going to comment specifically on one of them or anything like that. But the technology is separate from its value as an investment vehicle. Okay. But moving to the markets, I see that as a completely different thing, and I spent a lot of time on that 4 weeks ago in the London speech. So since you're following so closely, no doubt you've seen that one, and I summarized it in one of the Q's and A's. It's just that I think that people are looking at stock markets and saying, you know, that's a signal that there's a major global slowdown coming. And I said, well, you know, markets react to everything. In fact, they usually overreact to everything. And that's okay. They're just more volatile than the underlying fundamentals. That's something we take for granted. But I spent all my time there to try and reconcile what we were seeing in markets with what actually the consensus outlook is. And I think it's quite reconcilable. And certainly if you layer on top of that consensus concerns about a U.S.-China trade war and what implications that could have for the global economy, I think it's totally justified. That is a very significant risk that we face. So, you know, slowing global growth, slowing growth everywhere in the response to a trade war, plus upside risk on inflation, as I said in my speech, that's what we called stagflation 40 years ago. And it's a very undesirable outcome. It's not good for anyone. So that, I could understand markets being preoccupied with that risk. I don't think it's the only possibility. And as a central banker, I have to take into account the fact that they could agree over the next couple of weeks, and sure enough, there you go, we get positive lift in the markets like we saw Monday of this week, but not on Tuesday, and so on. So, you know, that's about all I've got to say on that.
Is there a backstop?
Oh, is there a Poloz put?
Yeah.
No.
Over here at the back.
Esteban Duarte, Bloomberg News. Governor, given the recent data and developments in the real economy, as well as the reaction of financial markets, in particular the future markets, wonder if you see the range of the neutral rate moving somewhat downwards, closer to 2%.
No, I really don't know the answer to that. As I was trying to convey in the room, that all the work we can do, which is, you know, modeling international data, and the same research approach is being used in other countries, including the U.S., coming up with similar answers. But the fact is that we won't really know till we're there what really is the current neutral rate. There are too many things in there that could affect that, and certainly when it's like when you're talking about a difference, as you just said, 2%, closer to 2% instead of 2.5%. Those are rounding errors in that kind of research. Okay, so it sounds like half a point sounds like a lot in policy space, and you're right, it is. But in the space where we do the research to try to figure out where it is, it's a rounding error. It's in the statistical distribution. And so we won't really know until we can read how the economy is adapting to interest rates, to feel if the the ebb and flow is more or less in balance. And then we'll know that we're not stimulating and we're not putting downward pressure on the economy. And of course, as soon as you think you've got it right, then something happens like an oil shock or something to kind of change the picture on the inflation outlook. So you don't expect this thing to be some unmitigated constant that doesn't change. You know, the world is always changing in that neighborhood. So I think you're asking for too much precision on the thing. And I assure you that we're all over it. And so as we get there, we'll be talking a lot more about it and explaining why we think it's still higher, or if it's about right, or if it's something else.
Okay. Did you have a follow-up? Okay.
You said in today's speech that the future policy stance will depend on the persistence of the oil shock business and your assessment of capacity. Wonder if you could explain what stance means in that context, and whether there is a difference from pace.
From?
Pace.
Pace. Oh, well, normally when we talk about stance, we basically mean, you know, a point. And so when we say a neutral stance, that would be an interest rate which is neither expansionary nor contractionary. So it could substitute rate for stance, but stance is just a term that central banks use. So it's not a special word. It's just means you found a space where you're not contractionary and not stimulating. Okay. Does that answer your question?
Basically, my editors were asking whether there is a difference between stance and pace.
On pace. So stance is where you are.
Yeah.
And pace is assuming you're moving somewhere.
Yeah.
From where you are to neutral in this case, and the pace is how quickly are you likely to move there. And what we're saying is we're not going to be mechanistic about that. Our models would tell us, go there at such and such a pace. That's what a model would say, because it tries to capture the dynamics in the economy. But of course, it can't be as sophisticated as the real world. And so we add our judgment to that, and the pace is determined by the things we've mentioned in that last paragraph. Those are the main ingredients, but as I was saying to Kim, frankly, all those things kind of go into your new understanding of where inflation is likely to be 1.5 or 2 years from now. And if it's likely to be a little higher above target, then you're leaning towards a higher interest rate to keep that from being too much higher. Or if it was the reverse, if inflation was going to be lower, then you'd say, well, interest rates should not go up as fast. So that pace is being determined by the data. We have in mind a destination, but it's more like a neighborhood as opposed to a specific address. Okay.
Greg and then Dave.
Greg Bonnell, BNN Bloomberg. Good morning, Governor. You mentioned during the speech, of course, global trade risks to the upside and to the downside, and you said it was somewhat encouraging what happened at Buenos Aires and the dinner. In that vein, is it somewhat discouraging that Canada has arrested the CFO of Huawei at the behest of the Americans?
Well, I won't comment on a specific development like that, Greg, but what I did observe in the room is that the news flow has markets sitting on the edge of their seats on this issue. So it's obvious to me that that is the dominant risk that markets are wrestling with. To move so big up and then so big down, on the basis of a tweet or something, that's volatility that I haven't seen before. Usually you would filter such things, and the fundamentals would play a bigger role. But in fact, it is a highly uncertain thing, and it's like a lights on, lights off kind of risk. So as I said a minute ago, I understand why markets are behaving that way. So what we can hope is that the encouraging signs we saw over the weekend have a fundamental base, and that develops into something which reduces this risk for the global economy. Much like, you know, if we go back 6 months, everybody was, I would say everybody, but many people were totally convinced that NAFTA was going to be torn up and that no agreement would be reached. And we sat in the press conference, Carolyn and myself, and said, look, this is a two-sided risk. We can't assume the worst. We're mindful of it, and yet we think, you know, we have to at least take into account that it could all get signed and resolved, in which case there'll be lift. And it wasn't much longer after that that we got exactly that. And you know, I was with the Canadian Business Council that day, and it was palpable in the room, the relief that was there. And so those are the people that spend all the money. Those are all the investments that we track. So I have every reason to think that now we're headed for stronger investment, and that'll be enhanced even more by the capital depreciation allowance rule changes that the government has introduced. So all along, back when we figured this was mostly over, we knew the leaders of growth would shift from consumer and housing and cars to exports and investment, and that would make for a much more sustained long-term growth trend for the economy. So those pieces are coming together for us, and we shouldn't lose sight of that just because there are risks. There's always going to be risks.
Speaking of housing, you mentioned it as well. I know the bank is concerned, and other people are concerned that given the debt levels in a rising rate environment, people get squeezed. And then you made a comment about supply. You said, you know, classic economics, the best way to make housing affordable is to bring on more supply.
Yeah.
In the bank's opinion, why has this country failed to do that? I mean, there was a housing boom and people were getting insane prices for homes, yet the supply didn't show up.
Yeah, you know, supply of housing is a complicated thing. It's not like a company that can just say, let's work overtime for the next 2 weeks and put out 10% more product because there's extra orders. And everybody gets together and says, yeah, we'll do that, and we'll all make a bit more money and the company will be better and all that. But when it's housing, you've got to have your zoning, you got to have your approvals, you got to have the infrastructure installed, the sewers and the hydro and all that stuff. It's a major process. It's measured in years. And so you know, I'm not going to make excuses. I mean, the fact is, you're right that supply hasn't really reacted. It's just kind of moved at its normal, sedate kind of pace relative to demand in places like Vancouver and Toronto. I suppose it's for other people to decide if we could do better. I mean, I just observe that, you know, doing things that make it easier to supply a new house would help the affordability side. And I'm just saying, let's not forget that affordability was going down very rapidly as prices were rising at 10% or more per year, and that has come to an end, which is unambiguously good news for affordability. It doesn't make it suddenly more affordable, but the erosion of affordability has stopped. And the fact that interest rates may have risen a little bit in the background is not the big thing about affordability. It's important to understand it's all part of a system. Yeah, I won't go any deeper into the supply side, but it's a sticky process. I think that's the main thing. It's slow to adjust because of the nature of it.
So we don't actually have much time left, but I've got 3 more people on the list.
I'll speed up.
Okay. Dave is next. There's your microphone.
Hi, Dave Parkinson, Globe and Mail. Good to see you, Governor. Pretty significant switch in tone from the October statement to this week. Wondering if you can just sort of walk. I mean, it seems pretty clear that oil is the dominant element in that. Can you maybe walk us through what factors in oil kind of pushed that tone into, as I said, I mean, it's been pretty significant in terms of how it's changed the market perception too. So maybe you can just walk me through, you know, first of all, how much of it was the light oil, how much was the production cuts that are going to, you know, have an immediate effect on the marketplace, and how much was a need to shift market perception?
Yeah. Oh, there's no question, Dave. And you know, in terms of real shocks, I mean, first of all, the tone of the data have not been that strong for us. Okay, so we had a couple of negative surprises. I mentioned them in my speech. So even though GDP was, we had it listed as 1.8, it turned out to be 2%. Well, that sounds close enough. But underneath it, what we had is softer housing than we had penciled in, and much softer investment. So we try to look through those to figure out, well, is that temporary? You know, we got elements of it that look temporary. And so we see through those, but no, it doesn't change the fact that as we move in from Q3 into Q4, the handoff is softer. So as I said, we have less momentum going into Q4. Okay, so we don't have new Q4 numbers for you today. We'll have those in a month or so, but the point is there's a downside risk that has emerged for the actual forecast numbers. But that's not the big thing. The big thing is, as we look forward, it's how does this oil shock affect those macro numbers? And as I said, the main thing that's changed there since our last NPR is that it has spread to light oil, which is the majority of our oil. Okay, we put lots of emphasis on oil sands and heavy oil, as appropriately so. Why? Because that's where the new investment mostly is. So if as we talked about, you know, back in October, investment is being held back for lots of reasons, but one of them is that WCS was really cheap, and so if you're thinking of developing new capacity, chances are it's in the heavy oil space, and so investment in that sector has been weak now for some time. But the light has traditionally been, you know, it's already booked for room on the pipeline. You know, it's flowing through and it's earning just a small discount relative to WTI. But that discount has widened out dramatically in the last few weeks as those inventories have gone up. And so what I tied that to is something you need to understand, is that the big expansion of global supply of oil has come from the United States. You know, OPEC hasn't increased its supply. The United States has gone up by 2 million barrels per day over the last 12 months, and U.S. exports have gone up by 2 million barrels per day in the last 12 months. So that's going on to world markets. Okay. So all that is a pretty complicated picture, and we haven't done all the math around it. But we can tell, given that it's affecting our light oil more than it ever has before, that it's going to have a more widespread effect on the incomes that are being generated in the oil patch, and probably on the investment decisions, et cetera, employment. We have to find out more about that. And it depends, as we said in the press release, on its persistence. The production cutbacks are obviously changing this picture as we sit here. So we haven't been able to figure all that in yet. We need some time.
I mean, we have alluded back to the situation that we saw, you know, almost exactly 4 years ago at this time. Yeah. And leading into a January rate decision back in 2015. At that point, we were looking at a shock that in December, early December, we didn't entirely understand. Yeah. By the January rate decision, we had a rate cut.
Yes.
Is there? I mean, is that something that for the governing council is part of the consideration? I mean, at this point, so far people have been talking about, well, how is this going to slow down rate hikes?
Yes.
Is there a possibility that the governing council might decide that a cut is in order?
You know, I'm just not going to comment on that for now, Dave. It's just that we have to do our work in order to understand the shock better and what its magnitude actually is. And I've alluded to the potential scale. Back then, 30% of all the investment in Canada was in the oil and gas sector. Today, it's in the sort of high teens, so it's like 18%, something like this. Very important component of our investment. So the question is, how much is investment going to decline? It fell by like 50 or 60% in 2015. It's huge. So that materialized into a very, very significant shock for the macroeconomy. Since you're starting from a completely different base, as I said, it's hard to imagine it becoming anywhere that size. But we still have to do the work because it appears to be meaningful.
Gentleman behind Greg. Sorry, I don't know your name.
Victor Ferreira, Financial Post. Governor, you mentioned your early morning routine of getting into the office and taking a few minutes, couple or an hour or so to try to make sense of what's going on in the day. Obviously, investors are kind of having that same mindset right now where no one really knows where the market is going to go one day or the next. A tweet can rapidly change things, as we discussed. I'm just wondering, what are some of the things that you're still working to make sense of when it comes to the market? And I guess in these times of uncertainty, volatility in the market, what is it that the Bank of Canada can do to, ease investors in these times?
Well, like I mentioned a few minutes ago, the speech in London was an attempt to help people understand some of the market action that we were observing, that it actually fit together with the macro story that is actually was a very comfortable story. You know, a moderation of growth, that's a good thing because we're, you know, unsustainably strong in a few places. But if the preoccupation of markets has shifted from that base story to one which is a more negative risk story, which appears to be the case based on the action I see, then of course what we hope is that that risk will diminish as we go through the following weeks. I suppose if there's one thing that still strikes me as a bit odd is the level of long-term interest rates. It's still I would have expected it to have moved a little bit higher by now, in fact to stay where it was as opposed to coming down. And it suggests to me that people are focused on the growth impact of trade wars, which would be negative for global growth and indeed for all parties of the trade war. And there's an immediate thinking that that would lead to lower interest rates because it would reduce inflation risk. And that might be the basic thought process. And one of the things I wanted to take a moment for in the speech was to remind people that actually, when you raise tariffs, you raise prices outright. And in some of the things that are being contemplated, you would raise them a lot. And so it's true that we would have slower growth, but I believe we would also have an enhanced inflation risk under that scenario. And I don't think markets have embraced that the way I would think of it.
Just a quick follow-up on, you guys estimated that the loss of competitiveness from U.S. tax cuts and trade uncertainty, I believe you said would combine to lower exports by 0.6% between now and 2020. Just wondering if that measure has changed or if it's if you're still going.
Well, we'll have to readdress that. We of course tweaked some of those assumptions in the wake of the signing of the new NAFTA, but what we're from Missouri on it. We need to see how our companies actually respond. And of course, now we have a shift in our own tax system for companies to build into our next forecast. And so that will figure right there in that channel. At this time, I can't prejudge that.
Last question.
Hello, Governor. Armina Lagaya from the Canadian Press. I wanted to go back to the oil and gas sector. What concerns, if any, do you have that the oil and gas production now makes up a considerably smaller share of the national economy? Or would you say that it's a positive that Canada is less reliant on the energy sector than it was, say, a few years ago?
So I wouldn't offer a judgment on either side of this, but just to point out the reality that when we had oil of $100 or more, it was perfectly natural for that sector of the economy to grow faster than the rest of the economy. And indeed, that transfer of momentum was facilitated by the fact that the Canadian dollar rose while oil prices were rising. You know, the Canadian dollar was above parity for a time, which was very difficult for companies in traditional exporting sectors. So we're talking about from 2008-9 through to 13 or thereabouts. And so, as I said before, you can have this lead growth sector being the energy sector and a lagging or everything else. And it's like often is the case in Canada, you got part of the economy's got its head in the oven, the other part's got their feet in the freezer. And the average was still good, but you have these redistributions of growth. And then, of course, oil prices, global oil prices are roughly half of what they were. Never mind all the big fluctuations, but roughly speaking. And so you would expect that sector of the economy to grow more slowly, not necessarily to contract, but to grow more slowly. Well, the combination of lower oil prices and a lower Canadian dollar, which always come together, would give a boost to the other part of the economy. And that's exactly what we're observing. So I help you understand it. I'm not going to pass judgment on what's good or bad. It's just Mother Nature basically causes those things to happen.
But with those changing dynamics, is there anything that's of pressing concern now that that's just a much smaller proportion?
Well, it wouldn't matter to me if the energy sector were twice as big as it is today or half as big as it is today. It's still an important part of our economy. And as I said about the auto sector, 1% of the Canadian economy is 100% of the economy for some people. And so the adjustments are no less important. They're very important. And so, they're especially important for the individuals that are involved. So people will be getting laid off in the energy sector, as they have for the last 3 years, and as they will be in the auto sector. So what we hope is that the growth in the economy elsewhere is enough to compensate for that and create the jobs. And remind you that there's over 500,000 job vacancies in Canada right now, and many of them are in traditional sectors where the skill sets are more transferable than, let's say, if the jobs were all in writing computer codes. They just aren't.
Okay.
Great, thanks very much.
Thank you very much. That's we've got to call a stop to this now. Thank you very much, Governor. And that concludes the press conference.
Okay. Have a good holiday, guys. Yeah, see you.